As an Australian taxpayer, we're entitled to have asset throughout the whole world. There's nothing wrong to it. It's just that we need to disclose it and we need to plan for it in advance.
It's not things you can escape from.
No.
As you said, two things are certain, death and taxes.
Whenever you have any international association, you must speak to your accountant before you make any decision.
If you incurred a capital loss, you can only deduct it against capital gains.
If there are losses, the losses gets utilized on a gross basis.
When people invest through their industry super fund, what they often don't see is that taxation.
When people do their self-managed super fund, they were like, why is there a tax on my self-managed super fund? The tax rate is a concessional rate. It's a flat rate.
Hi everyone, welcome to another installment of the Investing for Doctors podcast. Today we have Munzurul Khan again with us.
Thank you.
He is accountant extraordinaire, and today we're going to be talking about some of the basics of the taxation system in Australia, which is going to be right up your alley, Munzurul. All right, so briefly today we're going to touch on a couple of topics. Income tax. We're going to talk about taxation within superannuation, and mostly focusing on the accumulation phase because this is a series for doctors earlier in their career. We're also going to be talking about some of the taxes associated with assets, such as capital gains tax, some various discounts we get on them, dividend tax, and also touching on franking credits. And lastly, we'll close off with a brief mention about GST and what that means for sort of doctors and sole traders.
Beautiful. Look forward to it.
We hope you enjoy this episode. So first of all, the structure I have in my mind is that everyone has a tax obligation when you have money coming in through the door. And you pay certain kinds of taxes on them depending on what kind of income they are. And you have to pay that amount unless there is an exemption, unless there's a discount, or there is additional levies for certain things. So you have a baseline level of tax, and then you get deductions or you get added things you have to pay at additional taxes. Is that how an accountant thinks about taxes?
That's right. I mean, there's two sides of this, right? So you've got the tax rate to start with, and you also have got the structure. And the structure also depends what the rate would be. So Australian tax system is a marginal tax system, right? And the marginal tax system in the sense that is as the income goes up, the tax rate increases. Now, of course, it gets capped to a certain amount. So we've got the highest marginal rate, which is 45% for $190,000 income. So anything over $190,000 income, whether you earn 1 million, 2 million, anything above 190 is 45%, right? So it's not an average tax system, it's a marginal rate, right? Marginal rate means that up to 18,000 you pay no tax, then you pay a small rate, which is 19%, goes up to 30, goes up to 37, goes up to 45%, right? So that sort of is the marginal tax rate that one sort of pays as an individual. Now, saying this is that there's a whole bunch of other things, right? So you've got your Medicare levy as an example, that's compulsory, and the Medicare levy is 2%, and that Medicare levy needs to be paid 2%. You also have Medicare levy surcharge, and you pay the Medicare levy surcharge if you don't have a private health cover, and if your individual income and or your family income is over a certain amount. Then you've got a whole bunch of other things. If you have government debts as an example, let's say HECS, and one of the previous episode we spoke about HECS a bit, right? So HECS as an example, if you've got HECS, that gets added as part of a tax. So tax can have different layers, right? It can get more and more complex. But to start with, it's an individual rate as a marginal rate.
Yeah, and compared to other countries, we are a progressive tax system. That means the more you earn, the more you get taxed, and the higher the margins goes, obviously.
That's right. A couple of fundamentals with the tax. One is exactly this, the marginal, the progressive rate. And second is that our tax system is a self-assessment system. And self-assessment system means is that with our tax system side of it is I as a taxpayer, whatever I say to the commissioner, prima facie commissioner will accept it, subject to any review, any audit at any point of time. Anyone is subject to review and audit at any point of time. But prima facie, it's a self-representation from our point of view.
Yeah, absolutely. And having myself personally lived in Singapore, even though I never paid taxes, in Singapore, the government assesses your taxes based on some very simple calculations because, when the tax code there is very simple, it's very easy for the government to assess it. Whereas in Australia, we've got probably one of the most complicated tax systems in the world, would you say?
Absolutely, 100%. And perhaps I'm digressing, right? Because I look back to our tax legislation, which started in 1936, right? And I remember that in 1997, it took us 60 years to change that legislation, update that legislation. What it did from 1936 to all the way 1997, it was all sort of a small things that we tried to fix a little bit of this, fix a little bit of this, fix a little bit of this, fix a little bit of this patchwork, right? For about 60 years. Gone all the way to 1997, and then we're like, this patchwork are not working, so let's just rewrite it. And one objective of that rewriting is that how do we make it simplified, right? But you know what was poetic is that we had this was the book, and I still remember the hard copy of the book. That was our tax legislation. After the simplification, we had 4 of those books and we had a separate book for MPT and we had a separate book for GST.
Yeah,
and I was like, hang on guys, now our tax has just gone up by about 6 times. So it is complex, very complex Australian tax system.
Yeah, absolutely. And, we're just touching about the basic stuff right now, and it's already going to be a very interesting topic. So obviously, income tax is tiered or at different rates for different earnings. The way that I often see people talk about it is that, every dollar I'm earning afterwards, I'm getting taxed at 45%, plus the 2% GST. And so what I want to actually mention there is that even if we got rid of the top tier bracket, you just fall down to the next tier.
Yes.
So we're not actually paying that much per dollar at the highest margin.
Good point. Very good point. It's a common myth, right?
Yeah.
A common myth is that, let's say, as an example, someone goes into 188,000 as a taxable income, right? The question I receive very often is that, I've got a pay rise of, say, 10 grand. So I'm going from 188 to 198. But as soon as I go from 188 to 198, my tax rate just increases to 45%. So I'm paying so much more tax. You are not. You are only paying that 7%. Higher rate on just the income above 190. Up until 190, whatever the rates that you had, that doesn't get changed.
Exactly.
Right. So simply because that you've got a $10,000 pay, it doesn't mean it goes back from $1 and average increases.
Yeah.
It's a marginal rate and it's an incremental rate above that 190.
And the additional point I wanted to stress on that is that when you earn over that, you're only paying 8% more because you go from 37% to 45%.
On that additional 8 or 10 grand income.
That's right. That's right.
All the rest of it remains the same.
So, I often hear this rationale, now that I'm already a tax bracket, every dollar I'm earning is going to be taxed so much. So there's no point in working more. Well, I was just like, by working more from what your original pay was, you're actually, for that bracket, jumping that bracket, you're only paying 8% more.
Very important point. Very, very important point. And I hear that all the time with sort of my clientele as well. And our answer is always exactly this. And our answer is go away and keep earning as much as you can. We will look after the tax, right? Yeah. You don't get discriminated because of your retrospective income. Yes, your subsequent income would be a little bit higher rate, but not so much the retrospective. Whether we say that as a grandfather provisioning, right? As such.
Yeah, that's I always find that it's a mindset thing that some people need to change. All right, so we touched on income tax. Let's talk about superannuation tax. All right, superannuation tax, as we know, our employers or we contribute into the superannuation, and there are essentially 2 ways to contribute into your super. One is using pre-tax money, and one is using post-tax money. And obviously with post-tax money, you're not going to get taxed on it again, right? So tell us a bit more about when we do what we call a concessional contribution.
Yeah. So we've got this SGC, as we call it, right, which is superannuation guarantee charges, right? It means that as an employee is that whenever I'm sort of earning a certain amount of income, the employer has an obligation to pay the minimum guaranteed charges, 11.5%, and it's sort of progressively increasing to 12, and it will increase more, right? So if there is a $100,000 income being earned, that 11.5, 12% that it needs to be added on top of that income. That's the minimum, right? Then you've got a maximum limit that the employer is obligated to pay, and the maximum limit now is 30,000. So 30,000 is the maximum limit that the employer must pay it.
Yeah, and that's just gone up in the last couple
That's right.
months.
It was about 27.5.
It was 27.5.
27.5, gone up to 30,000. That's the maximum that it can. Now, all of those payments are the superannuation guarantee charges, concessional payments, employers' payments, which all gets taxed at 15% within the super, right? Gets taxed at 15% within the super. Now, what I can do is that I, as an employee, I can also choose to make deductible contribution on my own. So let's say, as an example, the employer sort of has done about 20,000 as superannuation guarantee charges. I go back to my accountant and I say, oh, I want to get this tax effective strategy. And my tax effective strategy would be is that I do a salary sacrifice for 10 grand, or maybe I just pay 10 grand on my own to my superannuation fund and say that I want to claim that as a tax deduction. And because employer paid 20, I've got a 10 as a gap. And to go up to 30, I can still pay that 10 grand and I get that as a tax deduction in my hand. Because I get that as a tax deduction in my hand, it's a concessional payment still, and the super fund pays 15% tax on the other side, right? So that's all is concessional payments. SGC, superannuation guarantee charges, any personal taxable contribution from my end to a minimum of 11.5, going up to 12 or so, 11.5, and the maximum is 30,000. That's the concessional. Now, in addition to it is that what the government and the ATO has provides us is the non-concessional contribution. And the non-concessional contribution is the maximum amount that I can contribute on my own. And that is 120,000 per person per year that I can contribute. Now, I can roll over 3 years in one hit. So 120 could be 360. For 3 years, I'm doing it in one hit. And
again, that has just recently gone up as well.
That's right. It was about 110, right? So it's gone up to 120. And that 120 is what he was saying as a non-concessional. Means that I've already paid tax on it. This is my savings, and I'm just purely paying it out of my savings. So what that means is that, unfortunately, I don't get to claim it as a tax deduction. But when it goes to the super fund, there is also no tax to it. So there is no tax treatment on either side, either on my hand or on the super. Exactly opposite to the concessional, which has got a tax treatment on both sides. On my own hand, I get a deduction. Super fund pays a tax. Whereas in here, there is no tax on either way.
Yeah. And I think they're also being treated differently once they've been put into the superannuation.
That's right.
Yeah, and you know, I think that's beyond the conversation for today. But
Sure.
know that they are treated as two different pools of money within the superannuation regime.
Absolutely. Both as when they come in, as well as when they're going out, right? In terms of the tax side of it, they do.
Yeah. So tell me now, this is just a tax we're paying as we put money into superannuation. How are things taxed within a superannuation?
Yeah, superannuation has got a tax rate of 15%, right? And that 15% goes whether it's an industry fund, whether it is a self-managed super fund. Now, this is a bit of myth that I hear very often, right? Is that when people do their self-managed super fund, they were like, why is there a tax on my self-managed super fund? You always have a tax on your super fund, right? The tax rate is a concessional rate. It's a flat rate, 15%. So it is lower than the lowest marginal rate. The lowest marginal rate is 19%. You add away 2% Medicare levy, so it becomes 21%, right? But in the super fund, it's only about 15% flat rate as such. Now, depending on what level of income, right? The employer contribution is 15% and any other interest and all the rest of it is 15%. Capital gain tax in super fund is if there is a concession, you get a 1/3 concession.
The discount. Yeah.
Discount, right? So while it is a 15%, it goes down to 10%, and that's the tax rate from the capital gain. So 15% is the income tax and the capital gains. If there is a discount, 10%. Without a discount, 15%. Prior to the retirement, after the retirement, of course, tax-free.
Yeah, yeah. When people invest through their industry super fund, what they often don't see is that that taxation of that 15%. Why is that?
Yeah, two things that they don't get to see, right? They don't get to see, one is the tax, and also they don't get to see the management fee that the industry fund takes. Yeah. So I get questions from my clients very often saying that, well, if there is a super fund is established, there is an annual accounting fee of doing the superannuation fund, right? So the question gets asked is that, well, how does that compare? Because I've sort of never paid anything in the industry fund.
It's just because you don't see it.
You don't see it. You actually pay it. And the way the industry fund does is that they give you very often a net return. Very often they subdivide the net return pre-tax, post-tax. Sometimes they don't even subdivide the pre-tax, post-tax, right? So you get your industry fund return and the return sort of says, I've got a 7% return. Now that 7% return is a post-management fee. So it could very well be is that your return was actually 8.5% or 8% return. They've taken away 1% as the management fee.
And tax
the
as well.
running cost. Yeah. And 7%. And that 7% could be net of tax as well. So you're right. The tax is definitely there, whether it's the industry fund or self-managed super fund. The management fee is definitely there on both. It's just that the way it gets presented
of it.
is the net.
Yeah, because often when we do invest in industry super fund, you only see the units and the price of the units going up. There's no dividends coming through. There is no capital gains in there. Obviously, when you actually look at that structure, it's all visible because it's all published.
100%. And you've got all the different elements to it, right? Because say a common thing what you have with any industry fund or the self-managed super fund is the insurance. And very often your insurance gets paid, right? Whether it's a life insurance, TPDs, those two are very common out of the super fund. Sometimes people pay income protection as well. Income protection could be inside, outside, both. But life and TPD very often. So very often is that you sort of say, that's my net return. But if you go deeper into it, you can see all the different components. That was my gross, that was the income coming in, which is the employer contribution. That's the income being derived from the capital, which is being invested in there. On the other side, my expenses would be management fees. Expenses would be some of those life, TPDs, insurances. And then the tax, this is my net.
Yeah. It's another very complicated topic. And I think, again, maybe beyond today as well. So moving on from superannuation, that's we're just talking about the taxes in the accumulation phase because come retirement, there's an entirely different mess of taxable stuff going on there. So which is beyond sort of the conversation today because we're trying to target sort of the early career doctors on what we talk about. So the next one, we've briefly mentioned in the superannuation is capital gains tax. So briefly, what is capital gains tax?
Yeah, so capital gain tax is effectively the gain that you make on your asset and the tax that you are obligated to pay on that gain that you make on your asset, right? So there are some exemptions, like principal place of residence as an example, you don't pay any capital gain tax, right? But generally speaking, let's say that if we buy an investment property, right? We buy an investment property for $1 million and there was some buying cost, and so let's make it about 1.05 as an example. Over a period of time, that $1 million property or 1.05, let's say gone up to a certain amount.
So like stamp duty, for instance.
Stamp duties, right? We generally sort of say about 5% is give or take is the incidental cost. Stamp duties, solicitor's cost, purchase related, all the bits and
all of that
pieces.
Gets capitalized.
All of those capitalized. That's sort of the cost, right? So you buy for $1 million and you add away a bit of an additional cost. And let's say over a period of time, you sold it for a certain period of time, right? You sold it for $2 million. You sold it a bit more than $2 million and you pay some selling cost behind it as well. So even though you sold it for $2 million goes down a bit because there is an agent's fee and solicitor's fee and bits and pieces of bank's fee. And let's say on that example is that you made about $900,000 profit, give or take, right? That $900,000 profit, how the capital gain tax works is that entire $900,000 gets added as a taxable income. Now, if you hold that property for 12 months or more, then ATO gives you a 50% discount.
But that's only if you're a natural person.
Only if you're a natural person. Exactly, right? So on that example, say 900,000. If you're a natural person, 900,000 goes taxable income. We get a 50% discount. Our net taxable income becomes 450 on that example. That 450 gets added on my taxable income and I pay tax at my marginal rate. So let's say as an example, I'm already earning about 200,000. So I'm sitting at the highest marginal rate, and then all of a sudden when 450 gets added on top of the 200,000, I pay tax at 45% plus the 2%, right? Now that sounds pretty awful, right? That, well, I'm paying 45% plus the 2% medical levy, but the fact that it has received a 50% discount, if I look into the gross profit, is that I'm paying maximum 23.5%.
Yeah.
Because half of it I'm not paying any tax, and the rest of it, even if I'm paying at the highest marginal rate, is that I'm paying 23.5%. It's still a bit, it adds away quite a bit, particularly when you've got a larger amount, right? It adds away quite a bit, but it's 23.5%. The thing to take into account, the reason I say 23.5 times that by 2 is 47, and that 47 includes the 2% Medicare levy, right? So 45% is the tax and 2% Medicare levy. So that's sort of at a high level is the capital gain tax. But as we say, that the rate depends on where it is. If that gain is being made on a corporate entity, you pay straight the company's tax rate. There is no discount. If the company is sitting at 25%, you pay 25. If the company is sitting at 30%, you pay 30%. If it's an individual, you get that discount. If it's on a trust,
if it's in your super, it's
if
10%.
It's on a super, you get 10%, right? So you got 15%, 1/3 is the discount, you go to 10%. If it is sitting on a trust, you distribute how it is, and the ultimate beneficiaries pays tax. And then we can make it even more complex, saying that are you a resident, are you a non-resident? If you're a non-resident, tax is higher.
Discount. Yeah. But the concept of it is that it's something you buy and you hold and you sell it for a different price, then you have a capital gains tax. And I guess the flip side of it is that if you incurred a capital loss, you can only deduct it against capital gains.
That's right.
And you can't deduct it against your personal income because there are two different pools of money.
Absolutely correct, right? So you've got the capital gains. You are absolutely right. The discounted capital gains get added in your taxable income. But if you've got a capital loss, the capital loss you only carry forward. You can carry forward indefinitely.
It's not discount versus loss. So if you had $500,000 of capital loss, you had $1 million capital gains, right? It's not discount that by 50% and match it. It's you have $1 million there, you have $500,000 loss, they negate each other first, you have $500,000 of remaining gains, and then you have that 50%, right?
Absolutely. You are absolutely spot on. That's exactly how it is. If there are losses, the losses gets utilized on a gross basis, right? So you don't get discount, then you apply the losses. You apply the losses on a gross basis. If you've got $1 million, exactly as you said, if you've got $500,000 loss, I don't get a discount first, then I utilize the loss. That entire $500,000 loss gets offset against the $1 million profit that I made. So I'm being left out with 500,000 net profit. That gets a 50% discount, assuming that I'm over 12 months, right? So that's what the losses. If there are losses which is above, that you don't have any capital gain, or all my losses are higher than the gains, then I can carry forward that loss, right? And I can carry forward that forever, but I can't transfer the loss from one entity to a different entity. It just stays either with the natural person and or the entity which made the loss.
Yeah, that's right. Now the next part, we've spoken about properties. Capital gains also obviously works on, say, shares and anything you buy on the stock market or other sort of units in a managed fund and all that sort of things. They're all considered capital in nature. In Australia, we have this interesting sort of regime on dividends. So dividends are treated more or less like income in a way, and we get tax on that. But with that, we get what we call franking credits. So perhaps explain a little bit more on. So the way the franking credit works is that we go back to the main corporate entity who is paying the dividends, right? So the corporate entity, let's just say that it sort of made $100,000 profit, right? And let's assume the company is at 25% is the tax rate, right? So the company pays 25 grand tax, and the company has got 75 grand net cash being left. So when they do the dividend, is that what they do is that they sort of say, all right, we're going to do a dividend of 75,000. Let's just say whole amount gets dividend paid. So when that 75,000 comes into you as a shareholder, you naturally get that 25 grand, the tax that the company paid, as a credit on your name. We call that
franking credit. So in your hand, you've got 75, but you've also got a 25 grand as a franking credit. Then what you do in terms of your tax return side of it is that you sort of say, okay, 75 grand was my fully franked dividend, 25 grand was my the franking credit. So tax me on that entire 100,000, even though I received 75. Tax me on that entire 100,000. Whatever my marginal tax rate comes in, take away 25 grand against it, and the balance is the one that I will pay tax. Now, that whole mechanism, what that tries to do is to take away that double taxation, right? Because the company has already paid a certain amount of tax, all the commissioner is trying to say is to say that, well, ultimately the tax would be at your marginal rate. And if your marginal rate is higher than 25, you pay the balance of it. If your marginal rate happens to be lower than 25, then you would get that as a refund, right? But it's all about that equality, saying that it needs to be paid tax at your marginal rate. Now, if the company decides not to pay tax, let's just say company made $100,000 profit. However, company has got a whole lot of a depreciation as an example, whole lot of a non-cash items that they can write off, right? And they sort of say, all right, we had a whole lot of fit out plants and equipments and everything that we had. We've already spent that in the prior year, and I'm going to write it off against that 100 grand. Means that you had 100 grand accounting profit, but you had no taxable profit because you use the depreciation. On that example is that when that 100 grand, in that example, because there is no taxable profit, I use the depreciation to write it off, means that the company hasn't paid any tax and the company has got the full 100 grand in their hand. Now, if that 100 grand being paid to you, then it becomes an unfranked dividend because there is no franking credit, there's no tax being paid. And then when it comes to your hand, you pay tax on that entire 100,000 at your marginal rate, and you've got no credit to claim to, right? So again, it comes back to that whole concept, same, that it's all about making it fair, that ultimately the tax goes back to the individual name on the individual rate.
Yeah, geez, that's a very complicated topic, made very simple. And you know, we touched on the two extremes. There's obviously the one where it's partially franked. So let's not go into that. But essentially is that whenever you get a dividend, you will get a component of franking credits. That could be 0%. That could be, you know, up to 30%, for instance, because you can't actually go more than that because the corporate tax rate is 30%. And I'm just going to make an anecdotal sort of mention is that in other countries, and I go back to Singapore again, in Singapore, there is no dividend tax. And part of the reason for that is the corporate tax rate is often higher than the individual person tax rate. So there is no need to make it complicated. Whereas in Australia, it's the other way around. The personal tax rate is often higher than the corporate tax rate.
You know, as soon as we go into that international, it's so exciting because like it's each country is different, right? Each country is different. Each country has different rate, the individual rate, the corporate rate. They've all got their own level of prickles, so to speak, in terms of their sort of the tax side of it. The only comment which I say in here is that as an Australian resident, when we say as an Australian resident, the resident from a tax point of view, right? If you're an Australian tax resident, wherever your income are, everything ultimately gets taxed in Australia at the Australian marginal rate. So on that example of Singapore as an example, right? Let's say if you were to be earning that income in Singapore, being an Australian resident, you may pay no tax in Singapore, but the fact that you are an Australian resident, Australia will tax that in the Australian rate. Now, in that case, because you paid no tax on Singapore, everything gets taxed in Australia. But let's just say if you were to pay some level of tax in Singapore, generally speaking, we get that as a credit, subject to double taxation agreement. We get that as a credit and we pay the balancing amount in Australia. So it's the worldwide income comes back to Australia.
You got the direction I was heading that conversation into.
Lovely.
And it's mainly that we actually do have a lot of doctors of Singapore, Singaporean, Malaysian descent, Southeast Asian descent, South Asian as well, and they often have assets overseas that are subject to Australian tax, because Australian
And
tax is on a worldwide
B,
income.
what I'm saying here, this is such an important point, because what I say is that whenever you have any international association, right, you must speak to your accountant before you make any decision. And the reason I say this is that it's complex. It depends on a country by country. It depends on whether you've got a double taxation agreement. There's a whole lot of complexity. There's this concept called deemed capital gain. And the deemed capital gain means that when someone is a non-resident, from a tax point of view, becomes a resident for the first time. Let's say your Singaporean doctor friends, as an example. Let's just say that they've been living in Singapore for many years. They've got a whole bunch of assets that they build in Singapore, and they've decided, you know what, I'm going to migrate back in Australia. What Australia would try to do is to tax it on day one when you're migrating to Australia. This is what the Singaporean doctor says, hang on, how are you taxing me? Because I haven't sold anything. I still have those assets. And the Australian government sort of says, well, it's a deemed acquisition and a deemed disposal. Because it's a deemed disposal, we would like to tax it. Now, there are ways that we can minimize it. There are ways that we can defer it. And there are ways we can absolutely take that away. But we must look through that in advance. And that's the message which I want to pass to all the audience, right? That if you have any level of international asset, wherever, right? I mean, you speak Singapore. I've got lots of clients who has the similar sort of things in UK, US, India as an example, right? They've got a whole bunch of different level of assets. It's okay. As an Australian taxpayer, we're entitled to have asset throughout the whole world. There's nothing wrong to it. It's just that we need to disclose it. And we need to plan for it in advance, because, see, under the OECD country, as an example, there is so much data matching at the moment through the Austrade, right?
Yes, absolutely.
So much data matching that all those information are already there.
In Singapore, they already have these treaty agreements to data match. So it's not things you can escape from.
No.
As you said, two things are certain: death and taxes. So I think I'd like to use the remaining couple of minutes just to briefly touch on GST. Right? It's in a way, goods and services tax. It's a sort of consumption tax on people utilizing, buying goods and services, and that's currently at 10%, and it's taxed on, most goods and services, not all. For instance, in our situation as doctors, we medical services do not have GST attached to them.
Yes.
And there's certain products out there, like I believe coffee is not taxed GST, and they might have removed GST on sanitary products as well. Anything to really...
I mean, GST is 10%, right? And GST is that if you've got an enterprise, you charge 10%. So generally speaking, the only exemption that we have GST is that fresh food products as such, right? And anything which is sort of a fresh food, GST free, but if it's being packaged, then it is GST-able, right? So very often is that you've got a fresh, say, fruits as an example, that may not have a GST, but you put it together into a package, that becomes a GST.
Oh, really? Okay.
It's sort of the fresh and sort of the packaged product, right, is what they do. And the rationale behind it is that as soon as you go into that packaged product is that it becomes an enterprise, it becomes a business. That's the ATO justification. Then we look into the profession side of it. That's the product, right? Yeah. That certain product are GST free. Then we look into the profession side of it. You're right. Generally speaking, the medical services are GST free, but also depends on what are we doing, right?
Oh, yeah.
Very often that management fee has got a GST, right? You are a GP and you're getting 75%, 25%, right? That 25% that we need to pay, very often there may be a GST component to it. So while you are not having a GST payable back to the ATO, you may still be able to claim a GST because of that management fee and the GST that you paid. So that's an important point in the sense that you still need to do your BAS, right? And when you do your BAS, you need to make sure that you claim it back. And similarly, there could be other incidental costs that doctors has, right?
Yeah.
Accountant's fee, travel expenses, buying some equipments, and so all those could have a GST. So those GST can still be claimable. So you may have a $0 GST payable to ATO, but you may have a GST refundable. Very common with the doctor side of it. Very, very
absolutely.
common. And third thing, which we say is the investment side of it, right? So GST is on the product, GST is on the service, and the GST is on the investment. And the investment side of it, again, perhaps in a later day we explore, but things such as when you've got commercial property, you've got a GST. Things such as if you go in a construction project, you've got a GST. Yeah. Things such as if you go into a business matter, you get GST as well.
Yeah. So again, that's a topic that we can probably talk for half an hour on, and we might save that for a different day because we're running out of time. So yeah, it's I think the things that we've talked about today are income tax, taxation within superannuation, and then we talked about sort of the asset taxes in terms of dividend and capital gains. And we also touched briefly on GST, which impacts a lot of doctors that become sole traders or become companies that do various things. I got to say, this is probably just the tip of the iceberg in terms of taxation. And there's just so many other things.
Absolutely.
Like we mentioned, there's land tax. There's also stamp duty, which is a form of taxation in a way. But we'll leave that for our next podcast.
Thank you.
All right.
Absolutely.
Thank you so much for enlightening us with all these issues.
Thank you very much. Thank you, B. Thank you.
All right.
Thank you, guys.